All right.
Have you ever looked at a company's financials, seen millions in sales, and then wondered how on earth they could be struggling to pay their bills? Well, the answer to that puzzle, and really the secret to understanding a business's true financial health, lies in a powerful concept called accrual accounting. And today, we're going to demystify it together.
This question right here gets to the very heart of the entire challenge. You pay in May, right? But the service, the actual flight, that doesn't happen until June. This simple little timing puzzle reveals the central problem that accrual accounting was specifically designed to solve. How do we accurately measure a company's performance when the cash coming in and the business activity itself just don't happen at the same time?
To figure that out, we're going to follow a very logical path. First, we'll untangle this difference between cash flow and what's really happening economically. Then we'll dig into the core principles of accrual accounting, walk through the essential adjustments that make it all work, and then see how it comes together to create accurate financial statements before we finally close the books.
All right, first things first, we absolutely have to draw a clear line between the moment cash changes hands and the moment economic value is actually created or used up. As you're about to see, these are often two very, very different moments in time, and that difference, well, that difference is everything.
The real difference between these two methods is, at its core, a philosophical one. Cash basis accounting is wonderfully simple. Money comes in, we call it revenue. Money goes out, we call it an expense. But that simplicity can paint a dangerously misleading picture of a company's health. Accrual accounting, on the other hand, which is what's required for most companies, shifts our focus away from the cash transaction and onto the economic event itself. We recognize revenue only when it's truly earned, and we record expenses when they're incurred.
So how does accrual accounting actually work in practice? Well, it all boils down to two foundational pillars, two key principles that govern the entire system. That's the revenue recognition principle and the expense recognition, or as it's often called, the matching principle. And here's the single most important takeaway. Revenue is tied directly to earning it by fulfilling your promise to a customer. So for Air Canada, that revenue from your plane ticket, it isn't earned in May when you hand over your cash. Nope. It's earned in June when they satisfy their performance obligation by actually flying you to your destination.
Now, this isn't just some vague idea. It's actually formalized in what's known as the IFRS 5-step model. Let's make this real with another example. Let's say you buy season tickets for your university's hockey team. You pay $150 in July, and that covers 30 home games. Now, the university can't just take your $150 in July and call it revenue. No way. They have to earn it. They have 30 distinct performance obligations, one for each game. So they're going to recognize that revenue game by game, $5 at a time, every time the puck drops.
And this brings us to the other side of the coin, the matching principle. This creates a really clear cause and effect link. We have to record the costs, the effort, in the very same period as the revenues, the results that they helped generate. This is incredibly important because it stops companies from playing games with their profits. They can't just report huge sales in December, but then push the cost of those sales into January to make their fourth quarter look better. The effort and the result have to be matched, period.
Okay, so to actually apply these principles correctly, accountants have to make what are called adjusting entries. Think of these as little corrections that true up the books for all those timing differences. Let's start with prepayments. These happen anytime cash moves before the actual business activity takes place.
There are really two flavors here. A prepaid expense is kind of like a gift card. When you pay for a one-year insurance policy, you've paid for it, but you haven't used it yet. It's an asset, a future economic benefit you now own. On the flip side, you have deferred revenues. That's our Air Canada ticket. They have your cash, but they haven't given you the flight. To them, your cash is a liability, an obligation they now owe to you.
Let's walk through that insurance example to see it in action. On May 1st, a company pays $12,000 for a full year of insurance. That initial journal entry creates an asset called prepaid insurance. So why an asset? Because on May 1st, that company owns the right to 12 full months of future coverage. None of it has been consumed yet.
So here's the key question. When we get to the end of May, has the company used up $12,000 worth of insurance? Absolutely not, right? The benefit of that policy didn't just vanish all at once. Only one single month of that coverage has actually passed. And that is precisely why we make an adjusting entry. We recognize 1 month's worth of expense, that's $1,000, and we reduce the prepaid insurance asset by that same $1,000. This entry perfectly reflects reality. 1/12 of the asset has now been used up, and it has correctly become an expense for the month of May.
All right, now let's flip the script and look at the total opposite scenario. Accruals. This is what happens when the business activity, the earning of revenue or the incurring of an expense, happens before any cash changes hands at all.
And again, we have two main types. Accrued revenues for services you've already completed, but maybe you haven't even had a chance to send the invoice for yet. Accrued expenses are costs you've incurred but haven't paid yet. The classic example is employee salaries. Your team works the last week of December, but payday isn't until January 5th. You've incurred that salary expense in December, and you have to record it then, even though the cash won't leave your bank account until next year.
This table is a fantastic summary of everything we've just covered. Let's just take a moment here. In the first column, you see our 4 types of adjustments. The second column shows what would be wrong with our books without the adjustment. You'd have overstated assets or understated expenses and so on. The third column shows the fix. But here is the most critical point on this slide, so listen closely. Every single one of these adjustments affects one income statement account and one balance sheet account, and they never, ever involve the cash account. These entries are all about timing, not about cash.
So, we've gone through all this meticulous work of adjusting for prepayments and accruals, but what's the whole point? Well, the point is to create financial statements that tell the true story of a company's performance and its financial position, a story that investors, lenders, and managers can actually rely on.
After all these adjustments are logged, we prepare something called an adjusted trial balance. You can think of it as the master list of all the company's accounts, but now with their correct up-to-the-minute balances. This adjusted list is the single source of truth, providing the accurate numbers we absolutely need to build a proper income statement and a statement of financial position.
We're almost there. The final step in this whole accounting cycle is a kind of reset procedure. It's called closing the books, and its whole job is to wipe the slate clean and get the entire system ready for the next accounting period.
Now, to understand this, you need to know the difference between temporary and permanent accounts. Think of temporary accounts, like revenues and expenses, as the scoreboard for a single game. They measure your performance for just one period. And at the end of the game, what do? You reset the score to 0. Permanent accounts, like your assets and liabilities, are like the team's overall season record. Their balances carry forward from one game to the next. The closing process is what takes the final score of the game, the net income, and transfers it to the team's permanent record, which is retained earnings.
And this process does exactly what it says on the tin. It zeroes out all those temporary accounts. And this is what ensures that when the next period, the next game, begins, the income statement starts completely fresh, ready to measure the performance of that new period, and that new period alone.
So why does all of this matter? Why go through all this extra effort? It's because this whole detailed process gives financial statements 3 superpowers. It makes them comparable, so you can actually analyze performance from one year to the next. It makes them reliable, giving you a true and fair picture of financial health. And maybe most importantly, it creates trust, the bedrock that allows investors, lenders, and managers to make sound, critical decisions with confidence.
And that brings us to our final critical thought for today. Given all the extra work it takes, why is this method non-negotiable for any serious business? Why is accrual accounting absolutely essential for a company that wants to get a loan from a bank? Well, it's because that bank needs to see the company's real earning power, not just a snapshot of its cash balance. They need to trust the numbers. Because at the end of the day, a company that can't tell its own financial story accurately and honestly isn't just a risk, it's a company that's simply not worth investing in.